things.
This was not coordinated, by the way. We didn't coordinate this. You pulled out the polo 5 minutes ago. I was like, great.
Yeah.
We're matching today.
Unfortunately, the t-shirt I usually wore was quite wrinkled, and we have a new guest on this week, so want to show off a little bit.
Rock and roll.
But let's jump into it because he will be joining us later on, as we had mentioned in our post. But, I mean, jump into it. Massive week with Jerome Powell, with the interest rate hike on everyone's mind. And so right off the bat, if we're going to dive into what was the major news this week, so the Fed recently had a meeting earlier this week, and Jerome Powell gave a presser on all things interest rates and when we can expect an interest rate cut or hike, whatever it might be. And he re-emphasized his position that, and this was pretty cool too, a lot of analysts were asking, when would interest rates attack and would they come by the end of the year? How many can we expect to predict? But what he did was he stuck to his guns, talked about the data, said if inflation continues to trend down and hits that 2% inflation mark, that's when it makes sense to cut rates. For now, he sees no reason to cut the rates, and he said there's one of two paths forwards to a interest rate cut, one being obviously inflation trending down to the 2%, the other being the job market cooling off a little bit. And so that was the big news today, is 175,000 jobs were added in March, well below analyst estimates. So interest rate hikes or interest rate cuts might be on the horizon. What do you think?
Yeah, no, I think that's a great analysis. I also respect the fact that he was very open about essentially that the trends will determine like what happens. You know, it's always tough to balance out like where future inflation predictions kind of, you know, spread across like where interest rates look to be. So I do think that it'll be reactive per usual, right? I mean, it's always been reactive. It's never been a more proactive effect. It is really interesting to see how strong the employment sector has been. So, right, I mean, we were hiring out at Mogul, plenty of other companies that a lot of our friends work at are still hiring out. There hasn't been as many job cuts in the recent months, which is great. So yeah, only time will tell. Like I'm really curious to see. Obviously, hoping that those rates do come down. If not, we're fully prepared for that. So,
and so reason that we like interest rate cuts, obviously, it's just all about the cost of capital.
Yeah.
How much quote unquote free money you can get, how much leverage that you can get at a cheaper cost of capital, which enhances your return and makes the leverage accretive. That's something that we constantly focus on here at Mogul, but that's more on the interest rate side of things. I mean, if you want to dive into, obviously we have a little bit of time before our guest joins us later in the segment, but if you want to dive into, I know properties have been outperforming, crushing in all regards. Talk to me. Walk me through individual properties, high level, all of it.
Yep. Yes, you'll see some great updates come out across the board, but right now, maybe just going through it property by property. So at the Bowser, we did have our new tenant settled in this past month. All great reviews across the board. Alex did a great job making sure that house is just in the best livable condition possible. Obviously, location is outstanding. You know, everything's reporting that essentially everything's going really well there. And we'll have our first distributions for the new lease coming up here in May. And so that one was a mark to market at $4,100 on the new lease from the previous $3,850, I believe. Is that right?
Yep.
So that'll be a great mark to market there. You'll see an increase in your dividends and your net income on that property starting this month. That's super exciting stuff. Diving right into Tall Heath, which I call Tall Heath, which we call the Roman.
If we pause a little bit.
Yeah.
The Dallas market. Why are we still in love with Bowser? Why are we still in love with that Dallas market? Obviously, new tenants came in, have increased the margin, increased the amount that we're going to be able to distribute to end users. But why exactly do we love the Dallas market?
Yeah, so it was just going through a fundamentals refresh on a lot of the markets very recently. Can safely say that Dallas still projects very strong fundamentals. Right, we've seen appreciation in the high double digits over the past 3 to 5 years. With year over year, even historicals seeing about like 8 to 10% annual increases. So that will only continue. We love the employment fundamentals there. You know, it's a huge financial hub, right, across kind of the South and the Southeast and Texas as well. Dallas, you know, a lot of companies are moving their corporate headquarters out there. Goldman's obviously doing massive expansion that we talked about in the past. It's still a city that everyone wants to move to, you know, whereas kind of on the other side of things, we see some slowdowns in cities like Austin, right, that were traditionally, in the past, a little bit undersupplied and now are completely oversupplied, right? So that's cooling off a little bit. You know, we'll see forward fundamentals in cities like Austin start to come down, but Dallas and Houston, fundamentals are remaining extremely strong. Lots of growth from a population perspective, employment perspective, and I'm really excited to see what comes there.
Yeah, I mean, we liken Austin being kind of the tech hub of the South.
Yeah.
Dallas is that finance hub.
100%.
All these companies announce these pandemic era moves to Dallas and to some of the more tax-friendly cities.
Oh, yeah.
And so now we're going to start seeing that development come to fruition. With Golden moving down, obviously headquarters down there, and more. So that's a little bit of the Bowser. Walking the Tall Heat / the Roman.
Yep. Yeah. So the Roman, that one's just doing outstanding. You did see those record high dividends coming in last month. This month we already have 3 confirmed bookings, with the 4th booking bleeding into the end of May. So you'll see an update come through on that. That one's been performing outstandingly well. We haven't even formally marked that one to market yet, but I was actually just checking the AVMs, the mark-to-market value the other day as well. And that one's already north of 8 to 10%. So outstanding stuff there. You will see those dividends paid out for all those May bookings in the June month that you'll see, and hopefully we're targeting again that kind of 2+% cash on cash yield conservatively, which will be great because annualized, that'll be 24% plus if you continue kind of on a straight line income growth on that, and that's before appreciation, right? So that's before you factor in that 8% plus of where the property is actually marked to market today from where we purchased it, back in late Q3 last year. And so when you invest now, you will get the basis of exactly where we purchased it because we don't mark to market the value of those equity shares until the property is fully sold out. So make sure you invest. That one's filling up really quick. You'll see updates on how that one's selling out as well. We're seeing a lot of volume, really exciting stuff.
Yeah, I mean, we'll re-underwrite properties as they come about and as the economic data points in that direction. And I would say for the Houston market, it's just been consistently outperforming on both appreciation and rental income. That's just a market we're very excited about. I think that a lot of the darlings of the Sun Belts, like the Austins of the world, they were a little bit overhyped, and the overlooked markets like the Dallases, the Houstons of the world, they were performing just as well, if not better. Yeah. But because you had celebrity names and celebrity status going down to Austin and the likes of Joe Rogan building out this massive comedy mothership, you didn't really see a lot of that in the news around Dallas. You saw like little high-level snippets here and there. But
Matthew McConaughey.
Yeah, exactly. Austin is kind of a little bit more Hollywood, a little bit more fresh. Keep Austin weird is their slogan. So it's kind of, it made for better news to report on. Not to mention they have a number of music festivals that go down there. It's a pop culture hub.
South by Southwest.
Which is funny because they're one of the only major cities without a major team, a professional sports team.
Yeah, that's true.
I think they might be getting a soccer team.
Is that right?
They might be.
Okay.
But even then, it's like, that's not a football.
No, you're right. Yeah, I didn't think about that. That's true. Yeah. That's 100% true. And it's surprising.
Yeah, and so there's got to be there's obviously a lot of things, and Rainy Street going away, Rainy Street being one of the main going out streets in the area. But Rainy Street was a temporary bandage. Anyway, that's neither here nor there. If we were to go, I don't know, dealer's choice, the Logan or the Kendall?
Yeah, let's just hop right into the Logan. Speaking of fundamentals on appreciation, right? I mean, you really can't have a conversation about the residential sector and kind of a portfolio build on the single family side, on the multifamily side, without talking about what's going on in the Inland Empire, right? I mean, you have so much migration, both intra and outside of California. I'm just looking for the word there. Intra and inter. So I'm trying to sound economically smart here. So you see a lot of migration into cities outside of, the LAs, the San Franciscos of the world. Obviously we saw a lot of growth in the East Bay kind of coming out of the tech boom, right? Great case study there of where, peripherals of major cities start to flourish when fundamentals are pointing towards growth. And so right now in the Inland Empire, it's just a great, essentially, spot to have a lower cost of living without sacrificing your quality of living, right? So you're seeing a lot of professionals, especially in the tech sector, live out there and kind of reverse commute that 30 to 45 minutes into cities like LA, San Diego. You have direct access to Arizona, which is growing tremendously fast. So Inland Empire is great. That is where we purchased Jomar, known as the Logan, late last year. And that one, again, has an outstanding basis because we ended up purchasing that one off market at $950,000 at the purchase price basis there, and that one is marked to market today at 14% conservatively, which is absolutely ridiculous. So again, that's less than 1 year since the purchase.
And that's unlevered, right?
That's unlevered.
Yeah.
So that's less than 1 year, right? We're about 7 months out from initial purchase, and we're already at 14% year to date mark to market. So just absolutely outstanding. Couldn't be more pleased with the way that one worked out from a basis perspective. We are starting to see bookings come in as well on that one now, so you'll start to see your dividends be paid out starting this month actually, and growing over the next couple months. So really exciting stuff there. I think we touched on the fundamentals of the market, so don't need to touch too much on that. But
yeah,
really good stuff.
I'd echo that even stronger with the industrial boom that happened along that, and it's San Bernardino County. It's a pretty great county to be a part of, and that's exactly where Logan's located. So definitely exciting stuff there. I mean, last but not least.
So here we go into what I lovingly call Grantham, but we call the Kendall on the platform. And so, this one, absolutely tremendous fundamentals again out in Dallas, right on Lake Hubbard. And so, tremendous lake. We went out there a couple times when we were living in Dallas. Great spot. Right now, that one is actually going to be mark to market around 7%, and that's conservative estimate. So you'll see that one as soon as it's sold out, mark to market on 7%. And that was our most recently purchased property. So if you annualize that 7% that we've already experienced over the past, quarter to quarter and a half since we purchased it, just outstanding fundamentals. We're already seeing the bookings come in there. We have 2 solid bookings for May, which will cover our debt service. And then any bookings that come on top of that will be straight net income distributed to you. So very excited to see what happens there. The fundamentals could, as we've already touched on, could not look better in the Dallas and Houston markets, but very excited to see. So definitely invest in that one because, again, we're selling that one out at the basis that we purchased it at, which is 7% under where the current mark to market is now. So that's 7% growth on your appreciation. Given the leverage on that one, right, that's going to be a multiplied effect based off of that appreciation on an unlevered basis. So really, really exciting stuff.
Yeah, I mean, that was great comprehensive overview of all of our different properties, and you can go check them all out at app.mogul.club, and you can start investing. It takes 30 seconds. We like to treat it like our interest-bearing savings account, but much higher yielding. I mean, maybe you get 5% to 7% on an interest-bearing savings on a great day. But if you're looking for a much higher bearing interest-bearing savings account, no better place than real estate. Absolutely. And so with that, I mean, we are joined now by Kavan, one of the earliest investors in Mogul. Just a little bit of background about him. He has a traditional finance in JP Morgan through to Draper Dragon, where he is on the venture capital side of the equation, but he's one of the earliest backers of Mogul. And so he's going to be joining us here in just a second. But with that, I mean, we can actually, should we just let him in?
Yeah. We had the tremendous pleasure of meeting him and the rest of the team at the Draper Summit last year. So much fun. So many fun stories from that conference. Looks like he's ready to go. We'll let him in and look forward to speaking.
All right, let's see. There we go. Calvin, how are we doing?
Hey, Joey, how you guys doing? Can you hear me all right?
Hey. Great to see you.
Yeah, we can hear you. Wait, hold on 1 second. Let me make sure I got it. You can hear that, right?
Yeah.
All right, good enough. All right, welcome. You're coming in, joining us live from Miami. So sunny background behind you, but welcome to the show.
Yeah, it's a pleasure to be here. Thank you guys for having me.
So, I mean, jumping right into it, obviously you've got a massive traditional finance and venture capital background, and we just want to hear a little bit more. Obviously, a lot of things that we touch on are traditionally a little bit more brick and mortar, but venture capital being just an absolutely fascinating industry and us being a kind of a tech-based platform, we'd love to hear, what are you seeing in venture capital? What are some trends that you're seeing? Obviously, AI notwithstanding, and also around the tokenization space, but kind of in that order, we can get right into it.
Awesome, for sure. I mean, we're at a pretty interesting time in VC because the traditional markets have totally bifurcated from the crypto side. Q1 of this year for crypto VC was the most active since 2021. But for regular VC, it was the least active quarter in 7 years, which is kind of insane. And if you look at PitchBook, they show the exit value. We're sub 100 billion over the last 3 years. And in 2021 alone, there was 800 billion of VC exits. So It's been a good time to be a crypto VC, but to be a regular VC, I think it's been quite hard. And I think a lot of VCs still have really high valuations for companies that are probably unsustainable. So I think that's going to be interesting to see how it plays out in the future. But for crypto, it's been great. We've been super active at Draper Dragon. I think we've got over 10 announced deals so far this year, which is much more rapid of a pace than we did last year. And we've got many more that are still coming out. And then on specifically the tokenization side, we've been very active in RWAs. That's been one of the hottest sectors in crypto this year. I mean, you guys were early at the trend, and I think so are we. But it's great to see that the market is finally starting to recognize the value of tokenization for some private liquid assets.
What do you say is the biggest attributing factor to that massive boom, especially in the crypto sector, but down on the traditional VC side, and also with AI? I mean, obviously here the massive influx of capital going into there. So if you have that data, if you don't, no worries. But I'm very curious to hear what you attribute at least the crypto boom for the people that aren't crypto focused.
Definitely. I mean, crypto is very cyclical, and it was in a pretty big low, right, from the end of 22 through most of 23. And what changed was the Bitcoin ETF that brought in a whole new wave of interest. And every crypto bull market is driven by new people becoming interested in the space. So Bitcoin getting an ETF legitimized the asset, which further legitimizes the rest of crypto. And as people who are Bitcoin holders realize profit, right, from buying back in 2022, then now they're going to diversify into other assets, like new projects they think that are exciting, that are building new products, or maybe even the same ideas that are just getting better executed now. And so that's kind of the rotation that we've seen. And then hopefully the next part of this is going to be like retail and traditional institutions coming in and saying, we want to participate in the rest of crypto as well. I wish I had some better stats on AI. I mean, I think that's one sector that's been insulated from the VC downturn as well. Obviously, there's been a number of public companies that are performing really well in that space. There's been some acquisitions. But I think both crypto and AI are going to keep performing well for this year.
That's incredible. Where are you seeing like a lot of the LP activity come from, being on the capital deployment side, being on the GP side and the operator side? Curious to hear where you're seeing a lot of that, dry powder sitting, kind of where all that LP interest is coming from, especially like in the crypto world.
Honestly, I mean, even for crypto funds, like there's been a few fundraising announcements, but it's still a really hard time to raise VC capital because the people who write the most amount of checks, like they're not just looking at crypto individually, like you're one of many VC funds in their portfolio. And so they do top-down analysis. Like this year, we're going to deploy, 5% of our assets into venture capital, and then crypto is probably going to be a subsegment of that. So the fundraising LP side has been pretty quiet. Fortunately, we had dry powder for this, and a lot of crypto funds did have dry powder. 2020 through 2022 is like the best VC fundraising time in history. So people are still deploying from that. And then on the actual deployment side within crypto, I mean, it's been really, really wide range of things. Like I mentioned, RWAs have been hot. We did a bunch of restaking deals. I think that space is super exciting for crypto, and it's very unique to the space. Gaming has continued to be hot. We've done some of those deals recently as well. So those are some of the sectors I'd say that's been keeping people interested in crypto, like outside of traditional Bitcoin.
And if you're focusing a little bit more on that RWA, so real world asset for those of us or those of our viewers that aren't as familiar with kind of that lingo, obviously going back to the early days of crypto, right? Every time there was that Bitcoin happening around that 2012, 2016, 2020 boom, and now 2024 boom, there's always been an incremental demand on the RWA side, but it's kind of lagged a little bit behind it. What are some fundamentals that you're seeing pointing towards RWA? Where's the demand gone to? And what are some projects that kind of you're most excited about on the RWA side in relation to the asset class?
That's a really good question. Funny enough, the last 2 years, it's finally changed where RWA is actually having maybe a better performance than other sectors. This year, I forget which month it was, but it was the best performing subsector of tokens. And then based on the blocks data from January 1, 2023 till like last week, the total value of projects or of cash locked in RWA deals on chain increased by 700%. I think now it's at a TVL of like 8 billion. So people are getting interested, and I think it comes from two spaces. One, on chain, there are all these huge companies that are really important to crypto that have big treasuries, and they saw the value of their treasury plummet in the last bear market, right? So now when your treasury is worth a few $1 billion, it makes sense to diversify those assets into something that isn't going to crash when the rest of crypto crashes. And there you'll see companies like Ondo, Centrifuge. We're investors in them. I'm really excited about their offering. And then On the real estate side, I mean, shameless plug for you guys, but that's actually one of the spaces that really got me interested in RWAs. And that's like the second piece of what I was talking about, where you're democratizing access to finance. In the US, I think only 44% of people own homes now. And then also only 15% can actually afford a home based on like last quarter's data, right? So that means 85% of people can't afford to purchase a home. And Mogul is one of the best ways for them to get access to that asset class.
Yeah, no, you couldn't have said it better, or we couldn't have said it better ourselves. I mean, you recently went through a home purchase yourself. I'd love to hear kind of what drove you to purchase the home. What was the rationale behind it? What was the rationale behind that exact unit? Obviously, I know it was out of New York, but if you could just walk us through the entire process from bits to bolts. I don't know. What is that?
I like that.
So, I mean, when you real estate, you guys know this better than anybody. Like different markets have different factors, right? Like New York is historically one of the craziest real estate markets. And when my wife and I were looking for a home, it was like it's been at the peak. So we were looking both at renting and buying, and it actually ended up being cheaper for us on like a monthly outflow basis to purchase a home. And so now that we're building equity, we're like, okay, we got to find one that's in a good place, right? Where like it isn't like we're buying at the top. And we want to live in parts of New York that we like. So we had a couple neighborhoods, but Battery Park has actually been left out of New York's real estate appreciation since 2019, I think, when there was Hurricane Sandy, or 2018, whenever that was. And Tribeca is going through the roof, which is right across the street. So part of our math was like, okay, this area probably has a floor, and once some of the fortification they're doing for Sandy, it actually will hopefully catch up to Tribeca. So that was a piece of it. And then also just having a place where we could build equity, like that's a big part of our personal net worth now, which like we were talking about earlier, I think it's the best way that you can build wealth for yourself, right, in America and around the world. So to be able to do that was very lucky from our financial position. And we're hoping that eventually the Battery Park market kind of converges with Tribeca.
No, the Manhattan sector in general, it's like kind of like a blue chip stock, right? You're going to buy anywhere, it's going to go up because there's just a finite amount of space. Greatest city in the world. It's the only place that you can get something that's the best of anything at 2 a.m. I mean, having moved out to Dallas, I learned that the very hard way at 10 p.m. really wanting just X, Y, and Z. But Battery Park in particular, you mentioned the refortifications. Are you talking about the re-leveling where they're going to increase the? Is that what you're talking about? Because I know within Battery
I think that's
Park,
a piece of it. I honestly, my wife did like some really in-depth analysis for us on this before we made the purchase decision. I should remember better. But there's like a whole list of things that they're doing through 2025 in order to make sure that what happened during Sandy doesn't happen again. And I think people are kind of waiting to see like how that plays out, but it's going to be really good for the area as a whole.
Yeah, because I know that when I was just heading out of there, they were drawing up the plans to basically raise it by like 12 feet. And so they're just going to decimate everything and then raise it up, which is just a ridiculous undertaking in and of itself. So I'm sure you looked into that a little bit too.
Yeah, I'm really lucky that she had the spare time to do all of that analysis for her, and I trust her for us, and I trust her. But I think either way, like it's not going to go down a lot more. Like the appreciation in Tribeca was insane, and Battery Park real estate, like the average 2-bedroom, is almost the same price that it was back in 2018 and 2019.
Yeah, and with the process, I guess, where did you start? Well, like obviously you're going about buying a home. What's the first thing you did? Because a lot of people don't even know where to pull at that string or thread in the sweater.
Yeah, well, I was pretty lucky that we had done diligence on you guys before that, because I didn't want to get ripped off by paying like a buyer's agent 3% of the purchase cost. So we just used our connections and Street Easy a bunch to find buildings that were interesting for us. And then we would just go around and like message those people directly, being like, hey, we're interested in XYZ unit, you know? And then when it came time for the actual purchase, we were able to use that to our advantage to negotiate the price down, which is literally, I learned that directly from you, which is awesome. And from that point, we also were very selective in terms of like wanting like a building that has all the amenities and stuff like that. And so we ended up choosing a building where we had actually rented from those same property managers in San Francisco for a number of years, which made our life a little bit easier.
Yeah.
Wow. Small world. That's so cool. How did you, just without going into too much detail, but how were you thinking about like the financing environment as you were making those decisions with interest rates swinging? And obviously a lot of people have a genuine kind of almost fear, right, of being on the buy side right now for real estate. And then also sellers are so almost unwilling to sell, right? Because a lot of them are locked into, I think the average is around 4% for existing loans now. How are you just thinking about that as you went through the process?
That's a great question. I think the way that we did it actually would work for a lot of people. Like we were looking at like, okay, if we're going to rent a 2-bedroom in one of our desired neighborhoods, like this is our monthly cost, right? Yeah. And that's just money that's gone forever. And we were able to actually get a 2-bedroom that was just barely above that. I think actually now this year with the rental prices, it's probably, we're like breaking even essentially. And I know if I want to rent it, I could probably rent out for higher, but like our outflow is the same that it would have been to rent a 2-bedroom in New York. And now we're building equity in our home, right? So like, I think that's how we did the math. We also got really lucky with our interest rate. Like I worked at JP Morgan. I've been a client of them for a really long time. So I was able to lock in a rate like last year in March when they were like 5.4%. And even though we didn't close our home till months later, we were able to, because we had done the rate lock, we were able to get that. So it's like 1.6% below where rates are today, which is super lucky.
So smart. So smart. That's absolutely incredible. And you're spot on with that. I mean, that's exactly the right way to think about it, is like the number one thing that people are doing right now is that rent to own analysis, right? And typically in a lot of cities, especially kind of more your high growth secondary markets, it's actually cheaper to rent to own right now, as Alex was talking about, in a lot of your core cities that are considered kind of your blue chip stocks. There'll always be value in owning, right? It's like you can purchase something right now at the dip and say like a San Francisco and probably make out like a bandit over the next few years, right? As the city kind of comes back, as everyone's saying. But yeah, like that's amazing. I think the rent to own analysis is like the perfect way to think about it. Definitely a huge indicator in how we think about our acquisitions on the platform. So really cool stuff.
What was Oh no, go for it. Go for it.
I was just saying, it's really market dependent. Like my dad just got a place in Arizona, and there, I think it's probably better to rent right now than to buy, right? Because like the market's like so topped out from COVID and the demand increase that they saw. But New York, like the rental and the buyer's market is crazy always. So you gotta pick and choose.
So true.
So obviously you were buying in a market that was absolutely incredibly, I mean, it was hot. It was very, very hot to be buying, especially around then because interest rates were already starting to come up. So you started to see a lot of people that are coming off the sidelines saying, I got to lock something in before it even escalates further. And so I'm very curious, do you have any horror stories on kind of bidding for apartments, or was it, because I know for me, I actually wrote a letter to the seller, basically an emotional sob story letter about how myself and my girlfriend, we were going to move into it, and I could see my kids on the banister of the stairs going up to my... Anyway, I wrote and I don't know if that had any part in it, but I was willing to do whatever it took to get this house in a market where there were 20 bids coming in the door. Were there any sort of horror stories around that for you?
It wasn't necessarily a horror story, but it was definitely learning the first place that we wanted to put a deposit in. We visited in December of 2022. And by the time we got approved for our mortgage in February 2023, all the 2 bedrooms were sold. And nobody even lived in there yet. Nobody moved in for like 3 more months, which that just tells you how crazy the New York real estate market is. So the place we ended up getting, we were actually one of the first people to, I think we might have been like one of the first people to actually buy a property in the whole development, because we outreached them before they were even publicly selling. So I think for New York, like I have a bunch of friends that are going through the rental process right now. Like you can't look for an apartment if your lease is up in 2 months. Like you have to wait till you're 1 month out, because the supply comes on, it gets taken out immediately, and then nobody has extra supply like for the next month. So in New York, it's really, really tough, and maybe more people should do what you did. Like I might need to see that letter for the next time.
Yeah, it was written at like 3 a.m, where I was like, I gotta sweeten this deal somehow, but I'm not willing to go up on price. So here's how I'm gonna do it. I'm gonna bring an emotional component to it. And then I moved out of Dallas a year later, and it wasn't my forever home. Like I thought. Was there any sort of thing that when you were walking through the process, that you were like, I cannot believe that this exists? Because for us, I know we talk about it all the time. The middlemen, the people that are, escrow agents being one of them, where you're literally being charged to hold your money until the end of the transaction. Is there anything that you're just absolutely incredulous behind?
Dude, the escrow is the number one. I mean, I knew that from investing in Mogul. Like that's like in our memo for you guys, right? Like you're abstracting away that fee. But when you actually see how much money somebody made to just hold my funds for 3 months, like while we're going through the closing process, is one of the most painful things that I've ever witnessed. I couldn't believe it when we were signing, and like that's what was in there. You don't know the feeling until you really see it with your own money, you know? So that's one of them. We were lucky we didn't have a buyer's agent. Our seller's agent fee we were able to negotiate down, but just also like the process of closing a real estate transaction, like you sign so many documents. I could have signed away my life. I don't know what's happening to my organs if I pass away.
That's so funny.
Yeah, I know when we signed on a closing thing, I mean, we've done 2 back-to-back closings in a row, and it took over an hour and a half, and it was strictly from signing, and it was,
Yeah,
and you have to walk through. Yeah, and you have to walk through, and they have to be like, this is the exact section this is what this section means, this is what this section means, and you're like, all right, let's get through it. But it's an egregious, I mean, it's ridiculous.
Yeah, I mean, quite literally hours of time. Luckily, we're doing that one time, right? So that way you can transact on that property in perpetuity thereafter, after getting it done once, which is great, part of the onboarding process. But yeah, definitely hoping to cut down on that in the future across the whole real estate sector, if possible.
Yeah.
Well, you're already cutting down it for your users, right? Like
Exactly.
now I'm a proud owner of 2 properties in Texas, and it took me about 5 minutes to make those purchases.
Exactly.
And you'll receive those tax benefits to your account. You'll receive those dividends directly to your account. I mean, it's going to be absolutely incredible. I guess I'm curious too. Obviously, we touched a little bit on your home buying process and just how egregious it was, and that's a tame story, mind you. We've heard everything from the horror stories about a roof caving in to the floor falling out. And it's ridiculous what goes into a closing process. But I'm very curious on the venture capital side, if you're kind of going back to what we were discussing on earlier, what was your interest, I guess, in Mogul itself, right? Because obviously we're offering out this platform. What was your main benefit that was your investment thesis behind Mogul with the team at Draper Dragon?
Yeah, I think there's a couple of things that went into it. So one, we really believe in the tokenization of assets. Tim Draper's actually the one who got me on that, like just from seeing him in the office, how bullish he was. And I did some research and I was like, this actually makes sense, and a lot of the consulting agencies are very, very bullish on how many assets will be tokenized by like call it 2030 or whatever. Like I think BCG is a 16 trillion high case and real estate is 3 trillion out of that. So from a market perspective, it definitely fits something that venture capitalists are looking for. And then the second piece is from a product perspective, like, is this really serving the market? And I did a lot of work into this because I had to convince her I see why this is better than fractionalized real estate. And fractionalized real estate looks really nice until you read their fine print. You can't get any liquidity until the home sells, right? Which they anticipate being 5 to 7 years. They have no control over that. So they've done a lot of volume, but they haven't had a lot of exit success. And I think that's where blockchain is really adding a lot of value, because when you guys enable the secondary liquidity for your users, if life happens, right? Like if you need to get a couple $1,000s out of Mogul, like I know that I have the best chance of doing it with you guys than I do out of any other option that I have. And then the last piece is that you're making it available for people with as little as $250, right, of an investment. Most of the other people out there, it's like 10 to 50K minimum check size. Like if I have a 50K that I can put into real estate, I'm going to invest into a property directly or like maybe into a fund, I'm not going to invest into like one property on a platform with that. Whereas like Mogul now, you can like spread that apart and build your own big portfolio of real estate. And I think that's really cool.
Yeah. Well said. So well said. Yeah, 100%. I mean, not to mention, it's like you said, it's all in the fine print, right? Like we're constantly competing for fees, like a lot of other fees that you'll see on platforms. There's asset management fees, right, which is just charged on your equity to invest every year, sometimes north of a whole point to 2 points, 2 percentage points annually charged on your equity. There's the upfront fees, which on a lot of other competitors' platforms are north of 7 to 10%, right? We charge a flat 3% at the property level, and so the platform's actually fully free to use, aside from your transaction fees, which are charged to our third-party payment providers. But essentially, that return that you're getting in the real estate on the platform already bakes in all of the fees at the property level, including the management fees, right? Including the upfront capitalization fees. And so transparency is the number one key, right? Just like you were saying too. And I think one of the biggest pieces that we were focused on when we were building this initially was direct access, transparency with the lowest barriers to enter, right? So that's what we were striving to do.
And I would echo that.
Oh, sorry, Alex.
No, go for it.
The AUM fee was actually a big part of our analysis as well, which I forgot to mention. Now, like everybody else has like 1 to 2% AUM fee, which is crazy. Like you can't do anything with those funds, and they're just charging you on. Like that's good for their business, but it's definitely not good for the consumer. So I was a big fan of how you guys set it up, and then also the quality of information. Like you have the comps on the page, right? You have all the supporting documents that shows the valuation. Like there's no opacity on Mogul. If you want to really dig in and understand the property you're buying, like everything is at your fingertips, and that's a great buyer experience.
100%. I mean, that also translates directly into what a lot of the competitors were doing without leverage, right? I mean, leverage returns in real estate are so important, and it also directly translates into what kind of fees that you can get away with that are sustainable, right, in terms of your margin. So, if other companies are raising properties with 100% cash and they're charging that 7 to 10% fee, is because they're needing that fee on that purchase price to actually make up for the capital that they're deploying either from their own balance sheet or from third-party funds before they can sell out to their consumers, right, to their investors. So the beautiful part about our leverage points, you typically targeting that 70 to 80%, is we're really only raising that 20% and usually around stabilizing to 30% of the total capital stack on equity, charging the fee on the total purchase price as a smaller percentage on that purchase price, but then as a larger margin on the equity that's actually invested, making it sustainable for us, making it way cheaper, monumentally cheaper for our investors, and right, levered returns. Like at the end of the day, it's all about levered returns and real estate and venture capital, investment banking, and so I think that's one of the great things about levered returns as well.
And I would say too to echo the part about the fees, it's kind of ridiculous. So I got a chance to work with a lot of traditional asset managers during my time in IB, and obviously then we went to the alt asset managers. And it seems like a lot of these major players, the way that they're incentivizing consumers to come over is with lower fees. It's a fee compression environment. And you can either increase the amount of distribution channels to increase the amount of consumers that you bring to the platform, and you can also increase and become a one-stop shop. And that's another avenue that you can basically sway over consumers into it. But a lot of them are just using it to cut fees. And it doesn't make any sense to me why the cutting of fees is what they should be concerned about. What they should be concerned about is the returns that they're giving to the end consumer. Because it doesn't make sense. If I have a 2% fee, like Kathy would, for instance, and have 100% return in a year, what do my investors care what I'm getting charged on a 2% fee if I'm making 98%? And so it's a commoditization of the asset management industry that's driving a lot of these platforms to actually offer out real estate, because it is becoming a new and novel way of transacting into and out of a previously unthought of asset class by our kind of demographic that we're targeting. And so with us, we not only have the benefit of charging the lowest fees on the platform, but we're focused mainly on that increased return. Because at the end of our day, our success is only determined by the supply and product that we bring to market for end users, which increases demand on our platform, which increases the return to them because we have more properties that we can offer, more of a diversification play on a portfolio-wide basis. And so that's just a little bit of a rant on asset management fees, because I've done way too much diligence on asset management business at one point.
Yeah, I mean, would love to hear about how that was brilliant, by the way. Would love to hear about kind of how that translates into the world of VC, like how you typically manage those relationships with your investors, what you're looking at just for educational perspective too, to all of our listeners about, how you construct your portfolios. You kind of talked about it a little bit before, but would love to hear more insight into that as well.
Definitely. You're talking about just how venture capitalists maintain LP relationships and how we construct our own portfolio, or how it fits in the bigger scheme.
Yeah, I would love some insight. Yeah, absolutely. That sounds great.
So maintaining LP relationships one of the hardest and most important things about VC, right? There's a lot of VCs out there. It's the record for the amount of different venture capital firms that have over 50 million in AUM, and all they really care about at the end of the day is DPI, which is how much you pay them back over a time period. Until then, there are all these other metrics that people look at. There's TVPI, which is total value paid in capital, which eventually converges with DPI. And then there's the book value of your portfolio, which is what most people who have raised funds in 2020, 2021, 2022, like us, are in right now, where we've distributed $0, but we have a lot of marked up assets. And so this time period for us, where we're still in the actively investing phase, is just updating our investors on, these are the investments we've made. These are the ones where there's been a markup. We've been pretty lucky to have some that have actually gone through their token generation event, which is unique to crypto, but that's the way that most crypto VCs are making their money right now. And so we have some pretty solid markups on our books, which is nice to see. But until the end of the day, or until we return capital to our LPs at the end of the day, it doesn't really mean much, and it's hard to go and get more capital from them until you do that. And then for our fund, our strategy is to take a lot of bets in the crypto space. So we have a barbell. 50% is like later stage companies, anything over $200 million. And we write a lot smaller checks. So some that we have over there are like a lot bigger checks. So EtherFi, CoinDCX, Ledger, and a few others. And then we also do 50% of our capital into Series A and earlier companies where we write smaller checks and take a lot more shots. Because crypto is an incredibly competitive space, right? Like you can just take somebody's code and fork their protocol and make your own version of it, like SushiSwap did to Uniswap, and then be worth $1 billion. So we like to invest a lot in really strong teams that hopefully have a unique perspective on whatever market they're building in.
Very cool. Very cool.
That was a ridiculously good and comprehensive way to go through venture capital. I mean, I really appreciate that. And obviously, I know you're out in Miami, and I know that we're short on time together. So I know I just have a few last questions if we want to dive into it. But outlook, end of year. What is your outlook? It could be shooting everything aside. It can be in venture capital. It could be in real estate. It could be in personal finance. Just give us a spiel on what you think what's in store over the next 6, 12, 3 years from now.
Okay, those are some interesting time perspective. I mean, for the end of this year, I think that we're at a pretty precarious time in the market. There's been a ton of money that came in. Assets are all like generally pretty inflated. And I'm definitely cautious about how it's going to play out. But like as a personal investor, I think you have no choice but other than to participate and buy things that you like, So like I try not do any quick flips or like quick trades. You should just buy companies or buy homes or whatever it is that you really believe in, that you're comfortable holding for 5, 6 years or whatever it may be. And then for like longer term, like call it like 5 years from now, I'm really excited for us to get to the point where crypto is making a difference in people's lives. Like a thing that people don't really like to talk about is that there's like 6.8 million unique wallets that were active on chain last year. And apparently there's 570 million people that own crypto. So you're talking about like a 1% conversion rate to like actually using crypto products, right? Because you need a DeFi wallet to interact with the majority of crypto. And then it's really hard to actually keep track of this data because if you don't look at unique wallets, and it's even questionable how the methodology for that, like you might see that there's like 50 million users, right? But a lot of people have multiple wallets, 10 wallets. But I want to be at the point where like random people are using Mogul. They don't even know that it's crypto. And that's the reason that they own a home. Like that's the reason that I'm investing in the space as a venture capitalist. I think you guys are a big part of that. And then we've got some other companies that are pretty cool. They're doing things in gaming, in sports betting, right? Where like you don't necessarily need to know that it's crypto to have a better experience than you would have with the Web2 alternative.
Wow. That's great.
Amazing.
No, I mean, that was exactly what I was looking for. So don't worry if it was a broad-based question, but that was a good answer to broad-based question. I mean, do you have any last questions, Joey?
No, honestly, really, really excited to see you at the conference coming up. Really appreciate you taking the time today. But yeah, everyone else, definitely appreciate you tuning in. Any exiting remarks?
No, I mean, if you have anything that you want to say, thank you again, Calvin, for joining us and taking time out of your busy schedule to hop on with us, discuss all things venture, Mogul, real estate, and whatnot. But if you have anything last minute you want to say?
Well, I mean, I would love to hear what your guys' like 5-year outlook is. It could be Mogul or the markets or whatever. It would be cool to hear. I mean, part of the reason we invest in you also is because you're two of the smartest founders we have in our portfolio. So I'm sure you have a good opinion on this.
Yeah. I mean, you want me to go first?
Yeah, you go first. I'll get my 2 cents out.
Yeah. So, I mean, near term, if we're obviously there are a million different silos that you can go into. And so for us, if we're focusing on a Mogul specific silo, especially for real estate, blockchain, and obviously the buzzword being AI, I think the biggest thing that's going to happen in the near term is going to be realizing that real estate data is pay-gated by a million different gatekeepers out there. And so there's nothing in real estate that's a true comprehensive source of data. If you look at the MLS, which is arguably the definitive tool for realtors, you're not actually going to find true data. There's mistakes on there all the time. It's manually input by people that, quite honestly, take a pretty good swag at it, and ultimately they kind of just let it go, and then the next person uses that exact same data in the future. So I think we have a big problem with data as it relates to real estate. And so to enact any sort of change and create data or create real estate that is truly liquid and truly on-chain or truly an efficient marketplace, you're going to need to have a better source of data. And so I think in the near term, it's focusing on what will make that source of data. I think AI will be a massive part of it because that's petabytes of data that we're going to have to sort through and sift through and make sure that it is completely accurate. And so I think for real estate in particular, you're not going to be able to do this unless there is some sort of AI solution for it. And I think we're kind of in the early stage of talking with potential outlooks on that exact thing. As for the economy, if we're looking at it from the actual here to the end of the year, whether or not interest rates come down, I don't know. I think consumer confidence is at an all-time high. Balance sheets are at an all-time high. People are still spending. People aren't giving up their luxury goods. People are willing to pay the higher premium price for it. And so as a result of that, there's no need to bring down interest rate hikes or interest rates unless, for instance, Jerome Powell sees some sort of employment level data that will cause him to cut rates. So I think we're in it for the long haul, or at least the medium term haul, to the end of the year for interest rates. I think people are going to start coming back to the market as they see the need to move a little bit more in real estate specifically. Supply is going to be coming a little bit more online. You're going to see a little bit more demand, realizing that we're here for the long haul or medium haul. And I do think that people are going to start to realize that you can buy the house but date the rate, and you can come back and refi it in the future. And so I think that in the near term, everything's going to kind of coast along at this kind of stagnant but also very confident pace. As for next year, I'm a little bit cautious of it because something's got to give in order for the Fed to actually cut rates. And what we were talking about earlier, the Fed is traditionally a lot more reactive than proactive. And so something's going to happen that's going to push them in the direction that's going to make them cut rates. And at that point, it might be a little bit too late, but it will start to, we're going to see a dip and then ultimately it'll start to flatten out or even increase. And then beyond that, it's just, there's going to be a continuous push into these real world assets. A lot of the novelty that's in the space is going to go aside as platforms like ourselves come about with authentic and real product that is going to be high performing. But no, that was a rant, but anyway, go for it.
No, agreed. I definitely agree. I think my brain is always bifurcated into half macro view and half micro view. So it's like always tracking what's going on with fundamentals in the market. I completely agree with kind of what you guys were speaking about from an economics perspective. Very much going to be wary of where rates track, how that creates buyer frenzy in the real estate market, what's happening with dry powder in the public markets, and then also in the world of VC, and how that translates directly into real estate and kind of the growth of RWAs, the growth of the accessibility to private assets like real estate, right? That's something that we're definitely focused on, creating a larger market share for. And all of that ties into one way or another exactly how the fundamentals of real estate assets can perform, right? And so that's the other half of my brain is focusing on operations, like really focusing on fundamentals from a yield perspective, making sure yields are healthy on our cost bases, right? When it comes to the company, when it comes to Mogul, when it comes to the assets that we're putting on platform, always focused on yields, always focused on how that translates into exit values, marking assets to market. You know, there's always going to be that balance, right? Striking between operational and capital markets viewpoints, making sure that obviously you can maintain healthy yields to make sure that you can maintain healthy values on assets. And then all the economics around that will continue to affect both of those fundamentals. So definitely, keeping a close eye on things as we construct our portfolio on platform. You're going to see, eventually hundreds, but in the near term, tens of assets coming online over the next few months. Really excited for that. And we do have those 3 verticals, 2 of which are basically essentially market agnostic, right? So very focused on the fundamentals there, making sure, again, yields are healthy, working directly with sellers to circumvent give us a lot of headache in the world of real estate transacting. So yeah, my 2 cents, half my brain is focused on macro fundamentals, half my brain is focused on making sure operations are on the right track across the board, and we'll continue to see how that plays out.
And I will say there is one bit that I feel like people aren't talking about enough, and I'm actually kind of confused why they're not, is buy now, pay later. Obviously, massive boom in the industry and all these premium products. You can slice and dice this way or that and pay $30 a month. But the reason that credit cards came about was obviously to give people a line of credit and be able to buy things, but they actually feel a little bit of a repercussion in their credit score or feel a little bit of a repercussion in obviously their credit limit and what they're going to be hitting in terms of minimums, all that stuff.
Yeah.
But buy now, pay later, because you're slicing up these premium goods and because consumer confidence is so high, people are willing to take that $30 a month pay cut just to get a Peloton in the door. And so I think that's partially to blame for the stubborn inflation that we're seeing today. It's because people are paying the sticker value, but it's over time And as a result of that, buy now, pay later has exploded and consumer confidence has exploded as a result of it. But it's going to get to a point where it's going to people still have credit cards with the buy now, pay later. There's no sort of score that represents the buy now, pay later. I don't think credit score is necessarily the best metric, and I think it's a complete black box as to what happens to your credit score and if that's the best exact way to deem someone credit worthy. But at the same time, it's a little bit better than someone just signing up for an Affirm account and being able to buy a Peloton when they don't really have any sort of basis to do it. But that's something that I think might be simmering under the surface, so to speak. That was my 2 cents. But
to add to your point, one of my friends who works for a company that offers BNPL saw that people started using it for their groceries last year, which that's very, very scary. So yeah. I agree with you 100%. And I'm really glad that you guys both answered this question, because one of the things I left out of my answer is the importance of interest rates, right? And that goes across all asset classes. When interest rates go up, VC and the stock market typically go down. Now, the stock market's been like a little bit of an outlier, which is part of the reason that I'm worried. But when you look at the venture capital exits, as rates went up, exits went down. And that's going to be like the world that VCs are in for a while, for sure. And then for the RWAs on chain, funny enough, interest rates going up for a lot of them, like a lot of them are just tokenized treasury bills, right? Like that's actually a good thing. For private debt, rates being up is a good thing. And that's a huge component of what's tokenized on chain. For Mogul, it's better when rates go down. So I'm really excited to see what happens with the rate environment, and real estate's performing a little bit better than some of these other like less sexy asset classes. And I think it's going to be great for you guys.
Very cool.
Absolutely.
Well, appreciate you joining us as always, and thank you so much. And tune in next week for those of you that join week in, week out, and check out the properties because they're completely outperforming. But thank you again, Calvin, for joining us.
Thanks, Calvin.
And signing off for this week.
Have a great day, you guys. Thanks for having me.